Presentation is for Chapter 18, Revenue Recognition. In this presentation, we will first discuss the fundamental concepts related to revenue recognition and measurement, and then explain and apply the five-step revenue recognition process. In the second presentation, we will apply the five-step process to major revenue recognition issues, describe the presentation and disclosure regarding revenue, and discuss accounting for long-term construction contracts covered in the appendix. In the first learning objective, we will discuss the fundamental concepts related to revenue recognition and measurement. Recently, the FASB and IASB issued a converged standard on revenue recognition called Revenue from Contracts with Customers. This standard was issued to address the many inconsistencies and weaknesses of the previous approaches to revenue issues and is meant to provide a comprehensive revenue recognition standard that can be applied to a wide range of transactions and industries. The new standard adopts an asset-liability approach in that revenue recognized is based on the asset or liability that arises from contracts with customers. The contract indicates the terms and measurement of the consideration received, as well as the promises that the companies make. Without a contract, companies cannot know whether promises made will be kept. This slide contains the key objective as well as the five-step process that is used to recognize revenue. The purpose of the process is to determine, based on the contract, both the consideration received as well as the performance obligations that the company must meet in order to recognize revenue. Since many contracts involve multiple performance obligations, it is important to identify and then allocate the overall transaction price to them. Then revenue is recognized in the period that each of the performance obligations is met. We will discuss each step of the process in more detail in the following slides. In this learning objective, we will explain and apply the five-step revenue recognition process. In order to recognize revenue, it is important to first identify the contract with the customers. A contract is an agreement between two or more parties that creates both rights and obligations. Contracts can be written, oral, or implied from customary business practices, such as open accounts that companies have with customers. To illustrate contracts for the sale of goods, we will consider Margot Company that enters into a contract to transfer a product to Soon Yoon on July 31, 2020. The contract provides that Soon Yoon is required to pay the full contract price of $5,000 on August 31, 2020. The cost of goods transferred is $3,000. Margot delivers the product to Soon Yoon on July 31, 2020. To record the transaction, Margot would debit accounts receivable for $5,000 and credit sales revenue for the same amount. Margot would also debit cost of goods sold and credit inventory for $3,000. On August 31, 2020, Margot would record the receipt of payment from Soon Yoon by debiting cash and crediting accounts receivable for $5,000. The second step of the process is to identify the separate performance obligations included in the contract. A performance obligation is a promise made to provide a distinct product or service to the customer. A product or service is distinct when the customer can either benefit from the good or service on its own or together with other readily available resources. The identification of separate performance obligations is very important because goods or services that appear separate may in fact be combined as one performance obligation. In this illustration, we will consider whether the automobile sold by General Motors with 6 months of telematic services is one performance obligation or two separate performance obligations. Because both the car and the telematics are regularly sold separately without the other, They are separate performance obligations and not interdependent. In this illustration, we will consider Softtech, Inc. that licenses customer relationship software to Lopez Company and provides consulting services to extensively customize the software to Lopez's information technology environment. In this case, we would not consider the software license and the consulting services to be separate performance obligations because they are interdependent. Lopez would not purchase the software without it being customized by Softtech to operate properly on their system. The next step is to determine the overall transaction or contract price. Although in many cases the amount of consideration is easily determined because the contract is for a fixed amount, there are many contracts that contain terms that require more attention. We will discuss each of these in more detail in the next slides. Variable consideration means that the overall contract price is dependent on a future event. These terms might include discounts, rebates, credits, performance bonuses, or royalties whose amount will not be settled until some future date. In order to estimate the amount of revenue to recognize in the current period, companies use either of two methods, the expected value or the most likely amount. The expected value is used when there is a range of possible outcomes. This approach might be appropriate for a company that has many contracts with similar terms, and the outcomes can be based on a limited number of discrete outcomes and probabilities. The second approach is an either-or decision that is used when there are only two possible outcomes. In this case, the outcome with the most likely probability would be appropriate. We will look at an example of these methods next. Peabody Construction enters into a contract with a customer to build a warehouse for $100,000 with a performance bonus of $50,000 that is based on the timing of completion. Peabody will receive the entire bonus if the warehouse is completed on time, but the bonus is reduced by 10% for each week that Peabody is late. Peabody, having been in business for some time, believes that there is a 60% probability that the warehouse will be completed on time, a 30% probability that it will be completed 1 week late, and a 10% probability that it will be completed 2 weeks late. The variable consideration is the bonus, and the question is how much of the bonus should be recognized by Peabody. This slide illustrates both the probability-weighted and the most likely outcome methods. Based on the range of probabilities of completing the contract estimated by management, Peabody would recognize $147,500 of revenue using the probability-weighted method. Each of the revenue amounts for the three outcomes is multiplied by the likely percentage of occurrence, and the amounts are summed to determine the revenue recognized. If the most likely outcome was used instead, then $150,000, including the entire bonus, would be recorded, since this amount had the highest probability, 60%, of occurrence based on management's estimate of completion. It is important to note that estimating variable consideration requires that the company have experience with similar contracts and a basis for reasonably estimating the probability of receiving the variable amount. Also, the company must have an expectation based on previous experience that they would not have to reverse revenue previously recognized. If this is not possible, then the recognition of revenue is constrained. In the case of Peabody Construction that we just discussed, if revenue were constrained, none of the $50,000 bonus would be recognized until the contract was completed. Another aspect of revenue recognition involves the time value of money for contracts with a significant financing component. Interest must be accrued in cases where consideration is payable over time. The fair value of the consideration received or an imputed interest rate may be used to discount the future proceeds to determine the revenue recognized in the current period and the discount that represents future interest expense or revenue. To illustrate a contract with extended payment terms, we will consider SEK Company that sold goods to Grant Company for $900,000 in exchange for a 4-year zero interest bearing note with a face amount of $1,416,163. The goods have an inventory cost on SEK's books of $590,000. The fair value of the goods is $900,000, which means that the difference of $516,163 between the contract price of $1,416,163 and the $900,000 is the financing component. SEK would record the entry for the sale by debiting notes receivable for $1,416,163, crediting sales revenue for $900,000, and crediting discount on notes receivable for $516,163. They would also debit cost of goods sold and credit inventory for $590,000. At December 31st, 2020, SEK Company would recognize interest revenue for 1/2 of the year by multiplying 12% times the carrying value of the note, $900,000, and dividing by 2. The entry would be a debit to discount on notes receivable for $4,000 and a credit to interest revenue for the same amount. Short-term notes of less than a year do not require discounting to reflect the time value of money. Companies can receive non-cash consideration either as a contribution or as consideration for goods provided or services performed. Companies should recognize revenue based on the fair value of what is received in exchange for the goods or services provided. An example of non-cash consideration would be a barter transaction, where a company receives advertising services in exchange for providing goods. The revenue for the transaction would be based on the fair value of the advertising services received. As we discussed in Chapter 13, companies frequently provide incentives to their customers to increase sales, such as discounts, volume rebates, coupons, and/or free products or services. These elements should reduce the consideration received and the revenue recognized by the companies. To illustrate a volume discount, we will consider Samsung Company that offers its customers a 3% volume discount if they purchase at least 2 million of its products during the calendar year. On March 31st, 2020, Samsung has sales of $700,000 to its customer Arctic Company. In the previous 2 years, Samsung sold over $3 million to Arctic in the period April 1st to December 31st. The question is whether Samsung should record the revenue for the sale of $700,000 net of the volume discount of 3%. Unless there is information to indicate that Arctic would not continue to purchase goods as they have in the past, then Samsung should record the revenue for the sale net of the rebate by debiting accounts receivable for $679,000 and crediting sales revenue for the same amount. Samsung would record payment from Arctic by debiting cash and crediting accounts receivable for $679,000. If Arctic fails to meet the discount threshold during the remainder of the year, Samsung would debit accounts receivable and credit sales discounts forfeited for the discount of $21,000. After the overall contract price is determined, companies need to allocate it to the individual performance obligations based on their relative fair values. The best measure of the fair value is the amount that the company sells the goods for on a standalone basis. If the standalone basis is not available, there are methods that the company can use to make a best estimate of what the good or services would sell for. This slide illustrates three methods that are considered acceptable for estimating the standalone selling price for a good or service. The first method is to use the adjusted market assessment approach, which evaluates what similar goods or services are sold for by other companies, adjusted for the company's own cost and margins. Another approach is to add an appropriate margin of gross profit to the cost of the goods or services being offered. The last approach is to allocate the overall transaction price to the goods and services that have standalone selling prices, with the residual amount left allocated to the other good or service promised in the contract. To illustrate allocation of the contract price to multiple performance obligations, we will consider Samsung Handler Company that manufactures equipment used in the construction industry. Handler's products range from individual pieces of automated machinery to complex systems containing numerous components, with prices ranging from $600,000 to $4 million, inclusive of installation and training. The installation process does not substantially change the features of the equipment nor require proprietary information about the products for the equipment to perform according to specifications. Kai purchased equipment from Handler for $2 million and chose Handler to install it. Some companies choose to perform the installation themselves, but Handler charges the same price for the equipment regardless of whether it installs the equipment or not. Handler estimates the installment services to have a standalone price of $20,000. The standalone selling price of the training sessions is estimated at $50,000, and other companies can also perform the training. Kai is obligated to pay Handler the $2 million upon delivery and installation of the equipment. Handler delivers the equipment on September 1st, 2020 and completes installation on November 1st, 2020, at which time transfer of control is complete. The training related to the equipment begins when installation is completed and lasts for 1 year. The first question is, what are the separate performance obligations included in the contract? Since the installation and training can be performed by other parties, these services are considered distinct. Therefore, there are three separate products or services and performance obligations in the contract. The next step involves the allocation of the transaction price of $2 million among the three separate performance obligations. The slide illustrates the allocation. Each of the performance obligations' standalone selling prices is divided by the total of the standalone prices of $2,070,000 and then multiplied by the contract price of $2 million. For instance, the equipment costs $2 million irrespective of whether the customer chooses Handler to provide the installation or training. Therefore, the equipment standalone of $2 million is divided by the total standalone of $2,070,000 for an allocation of $1,932,367 for the equipment. The same process is followed for the installation and training, which have standalone selling prices of $20,000 and $50,000, resulting in an allocation of $19,324 to installation and $48,309 to training. When the equipment is installed and payment received on November 1st, 2020, Handler would debit cash for $2 million, credit service revenue for the installation of $19,324, credit unearned service revenue for the training of $48,309, and credit sales revenue for $1,932,367 allocated to the equipment. The unearned service revenue for the training will be recognized over the 1-year period provided in the contract. Handler would also record the cost of goods sold for the equipment by debiting cost of goods sold and crediting inventory for $1,500,000. The revenue for the equipment and installation is recognized on November 1st because both performance obligations were satisfied. On December 31st, 2020, Handler would recognize 2 months of the service revenue by debiting unearned service revenue for $8,052 and crediting service revenue for the same amount. The total service revenue of $48,309 divided by 12 is $4,026 per month, and 2 months of the 1 year of training has passed since the equipment was installed on November 1st. At December 31st, 2021, Handler would record the remainder of the service revenue for the training by debiting unearned service revenue for $40,257 and crediting service revenue for the same amount. In the Handler example, the revenue on the equipment was not recognized until the installation was complete and the customer accepted it. It is important that revenue not be recognized until the customer obtains control of the goods or services. There are indications of when control is obtained. Some indications are that the company has a right to demand payment or has transferred legal title or possession of the asset. Other indications are that the customer has significant risk and rewards of ownership or has accepted the asset. In each case, transfer of control is determined by the facts and circumstances of each contract and its terms. It is possible to recognize revenue for long-term contracts over time prior to satisfaction of performance obligations, as we will see in the appendix covering long-term construction contracts. In these cases, it is necessary to measure the progress of completion. Some contracts are better suited to measurement either in terms of cost or units or value added. As with transfer of control, the method chosen to measure progress is relative to the contract and performance obligations. This is the end of the first part of the presentation for Chapter 18, Revenue Recognition.